How does raising interest rates control inflation? Since the introduction of COVID, electricity, fuel prices, vegetable prices, internet prices, hotel prices, flight prices, and low interest rates have all risen. Russia's invasion of Ukraine, the worldwide energy crisis, on and off lockdowns in China, and pandemic-era supply bottlenecks have come together to produce an explosive cocktail of spiraling prices. Everything is becoming impossibly expensive. In an almost synchronized manner, central banks from all around the world are rushing to raise their key interest rates in a bid to tame high inflation, which, much to their dismay, continues to break monthly records. But the question is, how can the rising interest rate curb inflation, and how are they correlated? Well, this is what we're going to talk about today. Central banks have exclusive powers to issue banknotes and coins, control foreign reserves, act as emergency lenders, and guarantee the good health of the financial system. A central bank's prime mission is to ensure price stability. This means they need to control both inflation and interest rates when prices go up and deflation when prices go down. But what exactly are inflation and interest? Let us tell you in brief. Inflation is the continued increase in the general price levels of an economy. On the other hand, interest is the cost of borrowing funds. Normally, when inflation rises, central banks increase interest rates on almost everything. Economists also say that interest rate hikes are the best way of controlling inflation. Carlo Altomonte, economist and associate professor of economics at the University Commerciale Luigi Bocconi, SDA Bocconi School of Management, and SDA Bocconi Asia Center, told the Institute of International Finance that an increase in the interest rate will help reduce inflation, but at the cost of a significant slowdown in the economy. Altomonte says the banks will have to raise interest rates so much to induce a recession in the economy, which will lower demand, and this will lead to the slowing down of inflation. When the interest rate rises, the cost of borrowing also rises. This makes borrowing expensive. As a result, borrowing will decline, and as such, the money supply will fall. A fall in the money supply will lead people to have less money to spend on goods and services. This will lead to a decline in the demand for goods and services. With the supply remaining constant and the demand for goods and services declining, the price of goods and services will fall. As inflation is a continuous increase in the general price levels of goods and services, a fall in the general price levels of goods and services will lead to a decline in inflation levels. Interest rates tend to move in the same direction as inflation, but with lags because interest rates are the primary tool used by central banks to manage inflation. In the US, the Federal Reserve targets an average inflation rate of 2% over time by setting a range of its benchmark federal funds rate, the interbank rate on overnight deposits. In general, higher interest rates are a policy response to rising inflation. Conversely, when inflation is falling and economic growth slows, central banks may lower interest rates to stimulate the economy. These were some of the key relationships between interest and inflation. Well, now it's time to end this video. We hope now you understand why banks increase interest rates whenever there is higher inflation. If you have any questions about anything we said in our video, please leave them in the comment section. We will try to clear up everyone's confusion on the topic. And now, if you guys enjoyed our content, please like and share it, and don't forget to subscribe to our channel as we continue to produce business and finance related videos that will undoubtedly increase your knowledge of the business world. We'll see you in the next video. Till then, have a great time ahead.